SpaceX just completed the largest initial public offering in human history, surpassing a record held by Alibaba for 12 years. The offering raised $75 billion, resulting in a company valuation of $1.77 trillion. This chart compares that valuation to current revenue. While Apple has a price-to-sales ratio of 10 and Nvidia sits at 25, SpaceX is trading at nearly 100 times its annual revenue. Standard financial metrics do not account for this gap between income and market value. The S1 prospectus provides the specific breakdown for how this capital is managed. The filings detail a valuation strategy built on future projections, where the company's current revenue is only one part of a much larger narrative. Within the space segment, SpaceX aims to reduce launch costs to under $100 per kilogram, a fraction of the $54,500 NASA historically paid for the same capacity. Achieving this requires recovering the hardware. It uses large mechanical arms to catch descending boosters mid-air so they can be refurbished and launched again. Despite this technological lead, the space segment operates at an annual loss of $657 million. This chart shows the growth of Starlink, the company's connectivity segment. In 2025, Starlink generated $11.4 billion in revenue and $4.4 billion in profit. Starlink's global connectivity provides proven commercial viability that offsets the research costs of the rocket program. The newly formed AI division introduces a total addressable market projection of $26.5 trillion. To capture this market, SpaceX plans to deploy orbital data centers that run on solar power and radiate heat into space, bypassing Earth's energy constraints. Lease agreements with Google and Anthropic for data center capacity are already generating $2.17 billion in monthly revenue, roughly $26 billion per year. These AI contracts include a 90-day cancellation clause, allowing Etherside to exit on short notice. This reliance on short-term contracts for long-term valuation creates a specific risk for individual investors. We analyze these types of complex growth metrics in the Stewardship Finance Academy's free stock investment masterclass. You can join the next session by clicking the link in the description. Accurately valuing these companies requires a clear distinction between speculative projections and guaranteed recurring revenue. Between 2023 and 2025, SpaceX's debt grew from near zero to over $26 billion. This chart tracks a $20 billion bridge loan used to clear debt inherited during the acquisition of xAI. That original Twitter debt was transferred through multiple corporate acquisitions, eventually landing at SpaceX to be cleared using funds from the IPO. By raising $75 billion at a high valuation, the company only had to issue 4.2% of its total equity to investors. This three-class share structure ensures that the founder retains 84% of the total voting power. The IPO functioned as a corporate mechanism to clear private liabilities while keeping control in the hands of the founder. Earning an additional 1.3 billion shares under the current incentive plan requires reaching a $7.5 trillion valuation and establishing a colony on Mars. The founder receives voting rights for those shares immediately, making his position secure, regardless of whether those targets are achieved. The IPO structure enables the pursuit of large-scale space and AI ambitions while maintaining centralized control over corporate decision-making. Do you believe this valuation is justified by the company's long-term goals? Leave a comment below and sign up for our masterclass via the link to learn more.